Hey folks, Dan Frio here with your market update for October 30th, 2024. So here's where rates are. And you guys understand by now, these rates are what we use for the closing bell at the end of the night. So these are the top 6 products people use when they're buying their first house. Now, the interesting thing about today's news is it's all packed around what the Federal Reserve is going to monitor. And the big reason for that is, not sure if you realize it, but the Federal Reserve is meeting in 8 days and they're going to determine what's going to go on. So, and the headline news that we have right now at U.S. economy grow at a slower pace than was expected, but conversely, on the other side, U.S. payrolls grew more than expected. So we want to take a dive into these because this is actually giving us, what the Federal Reserve is going to look at and monitor. So the first thing we want to do is go over to here in GDP. GDP was slower than expected. Is it bad? Is it getting to the point where we should be concerned? Well, let's dive into the details in this one. So right now we saw the GDP grow at an annual pace of 2.8% during the period. Below, it was 2.9 growth from expectations. So it came in at 2.8. The economists were expecting 2.9. Where was it previously? Well, it says at 3%. So GDP is actually coming down. Is it a real concern? Well, economists are saying right through here, overall, the U.S. economy appears to be just doing fine. Okay, so that's what they're telling us. Meanwhile, the core personal consumption expenditure, which excludes the volatile food and energy, grew by 2.2% in the third quarter, or in the second quarter, above the estimate of 2.1, but a far cry from the 2.8 where we were. So right through here, here's how the economy grew over the last few years, and you can see that we're in line. So nothing to be kind of write home about or be concerned about on this side of the equation. So on this portion of the equation, the economy's doing okay. Now, the problem is right now is payroll. So payroll numbers just came in, and you guys know how I feel about ADP payroll. A lot of times they're dead on and other times they're completely off. This interview is fantastic because even Steve Leisman, now Steve Leisman is the CNBC's economist basically, and they use him for a lot of this analysis. He's completely surprised by a lot of the data that ADP is providing us because the concern we had was this. We had the hurricanes coming through. Is that going to skew the numbers? Well, it seems like they did a fantastic job scrubbing the numbers. Well, let's take her words for it so you can understand where she's coming from. She runs the ADP numbers. Then we come back, we're going to show you the effects on these numbers today, the GDP and the employment numbers, how they're affecting the bonds today and what rates are doing. Then we're going to go over to the CME Fed Watch tool to see if anything's changed there as well. And then we're going to take a deep dive into the economic calendar for the rest of this week because every other day is just completely news that the Federal Reserve really monitors. So let's get to the ADP payroll report so you guys can understand what's going on there. I learned something as well. Then we come back. I'm going to show you how the markets are reacting.
ADP October jobs numbers for the private sector up 233,000. That's against a forecast of just 113,000.
So double.
Service, good sector up 22,000. The service sector 211,000. Now there's the non-farm payroll estimate for Friday, which is government and private sector at 100. And I don't know what the street does with that. By the way, the ADP was revised up 16,000 from 143 to 159.
So ADP revised their numbers up from the last reading. Wasn't that much. But here's what he was saying. He said non-farm payrolls. This is what the government will report potentially on Friday. Is it 100,000? That's terrible. So that's what we're going to be looking at. But let's continue with this, the interview.
Closer, but last month they still were potentially underneath. So I don't know if this is potentially catch up, but we have Neil Richardson here. We'll talk to her in just a second. I'll give you a little more of the data here. The jobs were substantially in large businesses. Small was up just 4,000. Medium, that's 50 to 499 workers, up 86,000. There's large business up 140,000. And where were the jobs? Where the places where they've been. Education and health services up 53. Trade, transport, and utilities up 51. Leisure, hospitality up 37. Construction doing well. Professional business services doing well. The only decline in any sector was manufacturing, down 19,000. And now, as promised, as advertised, as promoted, you want to talk about?
Well, just before we get to
okay.
A lot of questions for her, but I'd like to see.
Here's also an interesting point. right up through here, the change in your annual pay. So how much the average person got in increase in wages. So if you stayed with your job, the average American, I guess, if you want to put it that way, or the average worker, my apologies, had increase in wages. Now, this is a national average. You might have got more, you might have not got any, but the national average is 4.6%. So we have inflation now at, let's say, 3. So at least you're keeping up with inflation, kind of. But if you change jobs, those people got a little bit of a boost in their income up to 6.2%. Again, with inflation now at, let's say, 3 at the high end, you're still doing okay when it comes to inflation. But we know housing, food, and everything else is taking a huge bite out of this. But my apologies. I just wanted to show you what these numbers look like in regards to payroll. Are people making more money, less money? Well, this is something else we also monitor on every time it comes out to see how wages are going.
The futures haven't moved a whole lot. I'd like to see what yields are doing in the Treasury market, because this morning, Steve, you told us that the only thing that's going to put pressure on yields at this point is weaker economic data. This is certainly not that. And 425, sure enough, is the 10-year. Earlier this morning, I think we were at 422, 421 when we checked, so a little bit higher.
Yeah, it's a little bit higher. But here's the wage data, Becky, which again is taken from millions of actual paychecks, up 4.6%. That is down 1/10 from the prior month. And that's job stayers, people staying at their job. And then going over to job changers, that's 6.2%. You would expect that to be higher, but that is also down 0.4% from the prior month. Now, I think we want to, it's Andrew's job to introduce Neela. Not mine.
You can do it. You're right there. It's all good. You can do it.
Okay, ladies and gentlemen, let's bring in Neela Richardson.
There she is.
Chief economist at ADP, the person who puts all
knows
this
these
together,
numbers
the
better
one
than anybody.
responsible for revamping. I will tell you,
How long have you had to know these numbers in your head?
I'm still like constantly remembering them, so I'm ready with the numbers. But luckily, I have Steve here.
I want to tell you, though, you probably know this already, your plus or minus absolute difference over the past 3 months is 29,000 with the payroll numbers. I know you don't even like that to happen because you're saying you're not predicting it. You're giving your own different estimate. First question, how do you treat strikers?
So as long as a worker, and by the way, good morning. I'm thrilled to be here in person. As long
You got to pay attention to this piece, because what they're going to analyze now is the strikes and then the hurricanes. And it's fascinating how they did these numbers. And believe it or not, the 3-year average of being, or a 3-month average of being off like 20,000 or so, that's not so bad, actually. But let's get to it. So she's focusing on this one because this is the important part.
as long as the person, the worker, is on payroll, we count them. So whether they got paid or not, they're still counted in our data set.
How does the government count strikers?
They count the number of people who received a paycheck. So if you work an hour or 40 hours, it makes no difference.
So if the strikers did not receive a paycheck, they may not be counted in the government.
That's right.
And you do it because they're still on payroll.
They're still on
they show up in the computer as being an employee of the company.
They're still an employee.
So that could be a difference, plus or minus 30,000 between it. How about the hurricane? What did you see in terms of the hurricane?
So we saw a quick effect in terms of the number of people who got paid. So we have two types of data. What we report are people on active payroll, but we still have paychecks. We still know who got paid during that week.
Right.
And during the reference week, which is when Hurricane Milton touched base, the reference week is the week we count in terms of the jobs numbers. We saw a 7% dip in both North Carolina and in Florida of workers who received a paycheck. That next week, the week of October 20th, it rebounded. So yes, there was an effect, but it was short-lived.
But that did not show up in your data because they were still on payroll. However, they may not show up. So this is fascinating, and let me tell you why. Because the whole game with the Friday number is looking through the distortions to understand the underlying strength.
That's right.
What you're saying is there's a lot of underlying strength if these people were not fired.
That's right.
And that we should really look through a low number because it's strikes and it's hurricanes, and that the number is maybe more in line with what you're saying.
I think so. We expected a cloudy, messy October for a variety of reasons, but two of which you've just outlined. But what the ADP data does is make that clear. We know who's on payroll, right? And it rhymes with other data like the initial jobless claims that also.
Now, here's the concern. Is the Federal Reserve do the same thing, or I'm sorry, the federal government do the same thing when they're analyzing the jobs numbers that are coming out on Friday? That's going to make a huge impact on what's going on, because the Federal Reserve, that's what the Federal Reserve is monitoring. That's basically the only thing they're moderating right now. So let's see what her response is on this one.
Also saw a peak up and then a dip down subsequent to the hurricane's landing.
So does the Fed realize that and pay attention to these other numbers instead? And I'll ask that of both of you.
I think the Fed is paying attention to a lot of economic data. You can't be data dependent for 3-4 years and not see the whole scope, both private sector and public sector data. So yes, this is probably an input along with other inputs of how the Fed is making their decisions. And if they look at the grand scope of data, they're seeing a broadly resilient economy, especially in October.
Neela, we have to wrap because we're going to break through more numbers. But here's a question. What about the wage data? The wage data seems to be coming down. The Fed has said it does not see the job market as a source of inflation. Is that your read from these numbers?
For an inflation watchers, this is the most important point. The economy is having its cake and eating it too. It's creating all these jobs while at the same time, wage growth is coming down, and that's good news for inflation. So we're really in a sweet spot in October. I don't know how long it lasts, but I'll take it this month.
This number today is going to be a big factor in thinking about understanding the number on Friday.
Sure.
And I know people dismiss the ADP number because it may or may not correlate. It may not be helpful to them in their models. But this is something that you have
gotten better. So you've been heard in the background. It's gotten better. So that, I used to discount when they came out with their news, and I was just like, well, it's not really going to do anything. So let's look at just the economic data that we have for today. So this is the data that just came in that they kind of reviewed. So let me just go through it with you real quick. So the numbers they were looking at, ADP payroll numbers. Last reading was 159. Expected to drop to 110. It actually doubled the 110 estimate at 230. So that's good news. Good news for the economy that's not cracking. Then we have the PCE, Q3, 2.8 previously, 2.2 now. It's coming down. This is that inflation number. GDP right through here was 2.5, now 1.8. GDP over the quarters, 3 to 2.8. So the economy, like she was saying, we have a stable economy. So you go back to one of the other articles that I have right here. It's overall the U.S. economy appears to be doing fairly well. And then you have the GDP growth right there. Okay, so that's the data coming in right now. Let's see how the bond market's reacting to this. So right now the MBS market is down or plus 0.1. When the news came out, it was minus 16. So we're having a nice little recovery through here. So what you need to understand here's the price of a mortgage bond that we follow here daily on our channel. And the reason why is this is the biggest component of your mortgage rate. The Fed doesn't control your mortgage rate. Banks, basically they use the yield on this thing plus profit margins to come up with their rate. So this is the avenue or the tool to use when you're trying to figure out what's going on with mortgage rates. How does this work? Well, basically it's pretty simple. There's a yin-yang effect. So if the prices like you're seeing right now, if they're going up, well, rates will be coming down. There's a yin-yang. Prices go down, rates go up. The bigger the move up, well, the bigger the adjustment. So that's what we're seeing right through here. Here's the economic strength, or basically just a snapshot of the economy. I'll take my head out of the equation right through this. So right now we're the federal funds rate. This is what the Federal Reserve controls. Here's the data that we're looking at. We have a federal funds rate at 4.75 to 5. We have an inflation figure right now at 2.2, and it comes screaming down from where we were last year. Unemployment rates at 4.1. Is that going to be tick up or tick down a little bit on Friday? That only time will tell. And then the GDP right through here is just revised. This was at 3 just the other day, and now it's at 2.8 on today's revisions. But if you go through here, look at the GDP. Well, let's just go back years. Okay, so the GDP prior to, let's say, COVID, maybe 3.3, 4.6, 3.2, 2.3, 2, 2, 2, 2. So you see a lot of twos in there. So this is in line. This is in line. This is in line. It does look like a Goldilocks scenario right now with things. So the next news that's coming out, major news, let's get to our calendar, will be on Thursday. We have the true PCE was coming out there. Continued jobless claims. We're going to see that as well. Initial jobless claims. So a lot of data coming in tomorrow. And then same thing with Friday. We have the average hourly earnings. This is what the young lady was just talking about. What are earnings doing? And then non-farm payrolls. And that data will be out on Friday. So basically between Thursday and Friday, we just keep getting all this data that the Federal Reserve is truly, truly monitoring. But since we're so close to the Fed meeting, we're 8 days away. The Fed is on basically lockdown. They can't really talk. They don't do any interviews. They don't say anything to the media. They don't do anything. They're basically on lockdown. So right through here, the CME Fed Watch tool, what's it telling us that's going to happen at the next meeting? Well, next meeting next week, there's a 96. Let's just say they're going to cut rates 0.25% next meeting. If they don't, it's going to be shocking the whole system. But then from there, where do we go? So from there on, I'm not sure. There was a vote yesterday. What happened, I was watching an interview yesterday, and there was world bankers all around the table, and this was CNBC that had this. And the young lady who was interviewing said, how many of you think there'll be a rate cut in the U.S. This year? Every person raised their hand. When she said, do you think there'll be a secondary cut in December? Not one person raised their hand. So that was concerning a little bit, but we're going to continue to monitor this. So watch every day so you can learn how this is all affecting housing. So like I told you at the beginning of the video, my name is Dan Frio. When I show you these rates, why do I give you this? Well, I'm a mortgage loan officer. Love to help you. So if you're out there looking to buy maybe your first house, first investment property, refinance, whatever you're looking to do, I'm licensed in all 50 states. That's pretty cool. And I'm also one of the country's largest mortgage brokers. We're set up with about 50 different lenders right now. So the cool thing about that is it's going to be one application, one credit pull, and we're going to shop your loan up to 50 different lenders. Who else do you know that will do that for you? So let us do all the heavy lifting for you. You guys have enough on your plate if you're trying to buy that first house right now, or maybe an investment property. So reach out to us. We'd love to help you. Go to therateupdate.com. Here's all our information. If you're looking to get started right now, you can hit the Apply Now button, or you can scroll down to the bottom and put in, or just give us a call at 844-775-5626, or you can reach me by email, yes, me, at dan@therateupdate.com. So thanks so much for watching, guys. God bless. Have a fantastic afternoon. And don't forget, we're going to be back here at 2:30 Central Time. Kyle Seagraves and myself with our live event to answer any questions that you guys have if it comes to buying, selling, refinancing, investor loans, the whole mix. We're here to answer your question. See you then. Bye-bye.